What is the expected return profile of investing in venture capital and private equity funds? We will explore this in this brief video. My name is Jacqueline van Ende and I'm a co-founder and the CEO of Carbon Equity, a climate investment platform that helps investors make their money matter more by investing in climate technology solutions. So how to think about the returns that you can earn in private equity? In a previous video, we spoke about the three forms of private equity. Venture capital, investing in early stage companies. Growth equity, investing in mature growth stage scale-up companies. And the third form, buyout private equity, where buyout funds invest in mature and often profitable companies. So how to think about the returns of each of these three flavors of private equity? Venture capital funds invest in early stage companies. This is the highest risk form of investing in private markets, but it can also deliver the potential for outsized returns. Think of having invested in a company like Tesla whilst it was still a seed stage company. You would have made an astronomical return. Venture capital funds that perform well typically return 3 times or more your invested capital, with an annual return in excess of 20%. So high risk, but also high returns. Not all venture capital funds will perform this good, and some might even lose money. Growth equity companies, as discussed before, are investments in scale-up growth stage companies. Typically, these companies have strong product market fit, an existing customer base, millions of revenues, and might already be nearing profitability. Investing in growth equity companies, therefore, comes at a lower risk. Lower risks also come with slightly lower returns. So the expected return profile of a growth equity fund that performs very well is to return 2 to 3 times your invested capital, with an annual return rate of 15 to 20%. Finally, buyout funds buy a controlling stake in mature and profitable companies. These companies are not at all as high growth as venture capital funds, but also much more stable. So the risk of investing in buyouts is, again, less than investing in venture capital or growth equity. Typically, you should expect a buyout fund to return between 1.8 and 2.5 times your invested capital, with an annual return rate of 10 to 15%. Now, there's another way of investing in private equity. Instead of investing directly into a single fund, you can also invest in a fund of funds. The main rationale to invest in a fund of funds is risk diversification. Instead of investing in a single fund, you invest in a portfolio of, let's say, 7 up to 15 individual funds, investing in dozens and hundreds of underlying companies. This much greater level of diversification significantly lowers your risk of investing in private markets. Typically, you should expect a strong fund of funds vehicle to return 2 to 2.5 times your invested capital, with an annual return of 10 to 15%. So in recap, venture capital investing can deliver outsized financial returns, but also comes at significant risk. Investing in growth equity companies comes at a lower risk and lower return, and investing in buyout comes at a modest return, but also very manageable risk. A fund of funds allows you to invest in all of these different strategies to mitigate your risk whilst delivering stable financial returns. Should you want to learn more about the expected return profile of our funds, schedule a call with one of our investor solutions managers to learn more.